I know I'm not asking for all the details, but what are some of like baselines that you're seeing right now as people are acquiring homes every year?
Yeah, I'm gonna answer all 3 of those questions. Let's first go back to, like, for me, everything has to be a principle. Everything has to come back to a framework that I can understand, and let's give you the framework of America, right? Before the Declaration of Independence was written, today it's written as life, liberty, and the pursuit of happiness, and I like that, that's good, but it actually came from John Locke, and the original statement was life, liberty, and property.
Yeah.
The reason people came to America, the reason America is what it is because there's contract law and property was written into the Declaration of Independence. And so if I know that, I also know that I have a contractual opportunity, constitutional opportunity to access debt. That is the game of money. And so you can actually access up to 10 single family homes, government backed Fannie Mae, Freddie Mac loans per person that has taxes. So if I'm married, I can get 20. If I hit my 20, and very rarely, I just showed you how to generate 6 figures of tax-free income with 14 properties. We have people, myself included, that have gone beyond the 20, and then we just go from Fannie Mae, Freddie Mac loans to DSCR loans, and you can go as far as you want with those.
And just define what those type of loans are.
So they used to be a lot more detrimental. They used to only be amortized over 15 to 20 years. They required a lot more points, but today they almost identically mirror a 30-year fixed mortgage from Fannie Mae and Freddie Mac. You'll pay a little bit more, typically a point more in interest, but you can amortize them over 30 years.
Love it. Okay, so that's question number one. Down payments on the first 20. I feel like most people, they're working on their first or second home. So if you get to 20, congratulations, you can call Ryan. But
Yeah.
on the first 1 to 20, what are some of the down payments needed to acquire homes?
Yeah. So we generally do 20%. If we understand the game of leverage, my objective is I want to keep control of as much of my capital as possible. And I mean, let's just go back to this idea that inflation is making us both wealthy and poor at the same time, depending on which side of the equation we sit. If I take a 30-year fixed mortgage, I get to buy an asset that inflation is increasing the value of that asset, but I get to then pay the bank back with less and less valuable dollars over 30 years. It's such a phenomenal opportunity. So I take 30-year fixed mortgages, generally put 20% down, sometimes 25%, just depending on what we're trying to accomplish. And then the objective really is like, when you understand this game, 80% of what you need to be financially free, it's sitting out there. It's waiting for you to raise your financial intelligence and go claim it. That is the game. Debt is the game, both on the income side and on the asset acquisition side. This is how you can accelerate your path.
I love it. I love it. And then they also wasn't even mentioned is the buy, borrow, die concept, and
Mhm.
the step up in basis that you get with real estate. Incredible. And you happen, arguably speaking, real estate portfolio and life insurance are one of the two best assets to die with. And why is that important? Well, if that's the case, it should only reflect on making a living better. That's what's weird. It's like, okay, if something's guaranteed that's going to happen, and you have assets that are optimized, and why is it where these two assets are great versus other assets? Well, l- getting leverage against them are a lot easier than you know gold, equities, and all. Like you can do all of that, but it's like literally real estate's built around leverage. It's like it's a very common thing. It's not like, oh, we'll have to see if someone can do that. I mean, there's like everyone's doing it. So by default, uh, real estate's just a natural asset to have with the buy, borrow, die, step up in basis, like that concept. I would even go as far as to say way easier than owning a business and trying to lend against it. Yes, if you're a billionaire, you got people to do it. But if you're a small business like you run, I run, we're not going to banks right now, and it becomes harder. Whereas like real estate's very very black and white, and then obviously life insurance is even easier when it comes to like built-in guarantees to leverage, and then obviously that income tax-free death benefit. So not only are you acquiring a greater asset with leverage, and I think doing it in a safe way, at least from what I'm seeing so far, which is awesome. You're creating the cash flow, but then you're also having two assets that are beneficial upon passing, which should only enhance your life while you're alive.
It's like peanut butter and jam, my man. I mean, let's go back to where we started the premise and the argument. Like, this is what
Yeah.
makes life insurance and real estate and business, if we're honest with ourselves. But these are the three assets. If you want to retire in 10 years or less, it has to be a combination of those three assets, period. There's no other way to do it. You've got to make a lot of money, you've got to keep a lot of money, and you've got to generate tax efficient income. And so here's what I love about this. You mentioned the step up in basis and passing on assets to your heirs. Like, the value of life insurance is the death benefits. The value of real estate is the appraised value that I can sell it for down the road. That's the value of the asset. Now, what makes life insurance and real estate so phenomenal is I can have the asset that has value and I can harness and leverage the equity for the present value, for the short term. So if I can leverage the equity, but still have the asset value and pass that asset value at its complete value onto a future generation, that's what makes these two assets work so phenomenally in this
Right.
situation and strategy.
Okay, next question, Ryan. How, if you're an entrepreneur that's doing this, you're literally doing this. You're owning real estate, but you're also investing in your business and continuing to grow your business. How do you decide what I'm assuming you're making money, anything that you're not spending is being deployed to cash value. And then how do you decide where you deploy it back in your business, back into real estate? And then do you own any crypto? I know that's a random, but like do you own any other
And then
assets?
you want to crypto
Real-
gut punch right there. Yeah, you know what? Always a delicate balance. My objective, and I think I heard this from Hermosia. It's such a phenomenal statement, but he says, "Think in decades, act in days." Right. And I love that idea of thinking in decades and acting in days. And as a business owner and entrepreneur, I think oftentimes we think we are both our business is the solution to our problem. But the more entrepreneurs I've worked with, the more I've realized they don't have an exit strategy and they dump
Yeah.
everything back into their business. And their business might be phenomenally successful, but they're not free. There's no exit. Their business owns them. And so if I think in decades and act in days, I kind of think about this idea that I want to get my business to a point that I have the ability to take both a salary from my business and profit from my business sufficient to hit my exit strategy in 10 years. And we did the math. So I know the math. So if I know that, if I'm in the beginning phases and I can't even keep my lights on in the business, every dollar needs to go back into the business. But if I'm at a point where my business and my margins are pretty healthy, I've got to start paying myself a salary. I've got to start, paying myself for working in the business. And then that I have to save 10% of all I make has to be mine to keep minimum. But really from a business owner standpoint, where I really kind of jack up the opportunity is my profits. I have a whole framework that I believe in strongly of taking quarterly distributions, profit from the business, taking it out of the business, fundamentally taking it out of your business bank accounts. And then if I choose to put it back in, here's the crazy part. The second it comes out of your business bank account, you realize that profit. And for some weird reason, you think it's yours. It was always yours. But in the business, you kind of let it just sit there. And then when something comes up, you're like, oh, there's money in the bank account. Just go do it. Right. But when I take it out and I intentionally choose to put it back in, I ask the one question that business owners never ask themselves: when do I get my money back? I treat it like an investment. And
You
so
have to.
you
You have
have
to.
to, you have to. And so for me, I want to think in decades and act in days. You
Yeah.
need to have a game plan as an entrepreneur to exit from your business. And the math, we can easily build that math for you, but then you have to go do what it takes to run a business that generates enough income and profit for you to be able to do it.
I love it. Couple more questions and we're gonna land the plane.
Oh, we
Obviously,
didn't get the
uh,
crypto question, dude.
oh yeah. Get to the
Come
crypto
on, you left me
question.
on a cliffhanger. Okay, so let's look at it this way, okay? I'm going to give you my crypto story. I'm going to give you my crypto answer in a framework, right? The only way, if I'm going to use leverage, the only way that I can use leverage is if I counterbalance it. This comes from Nassim Taleb. Nassim Taleb in Anti-Fragile talks about a weight, a barbell. If
Mhm.
I take if I look at life and I have a lot of risk and I level up my risk on one side, if I don't counterbalance that risk with no risk, de-risking the situation, I'll die, right? It's not going to work. And most people, they take so much risk across the board. Their income is risky, their investments are risky, their life is risky, their health is risky, and they live in a state of chaos. So the way I look at the game of money is if I'm going to use leverage, I want to counterbalance my leverage with hedges, with things that have zero risk in them. And zero risk is cash. So I keep a ton of cash. I have lots of reserves. I keep my cash value. And I look at those hedges against the external risk of the leverage that I'm taking. But if we now look at the world that we live in, the economic world that we live in, let's go back to the dollar. We just acknowledge that the dollar is very risky. They're printing a lot of dollars. And I think the foundational game of money is convert fake dollars into real assets. That's kind of what we talked about today. But the next level, I can de-risk the risk of the dollar by owning assets that counteract the risk of the dollar. Gold and silver is one of them. Now, I also believe Bitcoin specifically, not cryptocurrency, but Bitcoin, is a hedge against the risk of the dollar.